Hello all and welcome to Degrees of Freedom, where I cover 5 slides in 15 minutes about the note industry to enlighten you about your own degrees of freedom. My name is Dr. Engerman, or Dr. E as my students affectionately call me, and if that's a topic you'd like to learn more about, please hit that like button, please hit the subscription button, and hit that notification bell. Today we have an incredible episode for you. It's all about risk in note investing. A lot of people have asked me, what are the risks in this investing industry? And I'm going to unload all of those juicy details for you in brief so you can get on with your day. Today we are going to cover the following items. Accredited investors. Who are they and what are they and what do they have to do with the note industry? Default. What does it mean to default on a property and what are the causes of that? Deferred maintenance. What are those? Real estate protection, pitfalls, and recording. So without further ado, I think we should just get into it. Let's go big here. Alrighty then, you guys. Look, today we're going to talk about the risk of note investing, but first I always have to do my disclaimer. The information presented on the Engerman Estates channel is for educational use and purposes only. We are not financial institution or advisors. We're not financial strategists, lawyers, or CPAs. And if you would like that type of assistance, please go seek it elsewhere. Engerman Estates cannot promise the earnings or returns based on historical reports or achieved by any party or affiliate in connection with the information presented. So without further ado, let's get into it. Accredited investors. Accredited investors are a really important part of this industry. What it means is that you have a high net worth or you are generating quite a bit of income. And I'll talk about these in turn based on Investopedia and Forbes. But the reality of the note industry is that really it's a big boys game. Okay, it is a big boys game, and the legal system really views you as a big boy or big girl. And what that means is they are less interested in providing regulations and protections for this type of investment because they're feeling that you are sophisticated. And so here's the technical definition based on the Securities and Exchange Commission. So in the U.S., the term accredited investor is used by the Securities and Exchange Commission under Reg D to refer to investors who are financially sophisticated and have a reduced need for the protection provided by regulatory disclosure filings. Accredited investors include high net worth individuals, H&W1s or Is, banks, insurance companies, brokers, and trusts. So just in that little small 2-sentence description, you already kind of get the hint that the legal system and the SEC in particular, which is the big boy on the block, are really letting the big boys play in the big boy sandbox, okay, in a big girl sandbox. And so there are less protections provided by the regulatory system. Okay. Number 2, accredited investors based on a Forbes article and many others. You can go check this out on your own. But the SEC defines an accredited investor as someone who meets one of the following 3 requirements. Number 1, they have an income in their income that is at least $200,000 to $300,000 if combined with the spouse's income. This level of income should be sustained from year to year. Number 2, their profession is knowledgeable employee of certain investment funds or holds a valid Series 7, 65, or 82 licenses, which are investor licenses, allowing people to trade and understand trade and trading at the very highest levels. Net worth, they have a net worth of $1 million or more, either individually or together with a spouse, but excluding the value of the primary residence. Listen, again, this game of note investing is considered sophisticated assets for sophisticated investors, and the legal system really is not interested in engaging very deeply in the protections that would normally exist for things like stocks and bonds and things of that nature. Okay, this is a big boys game. Now, at this point, I usually let those that feel scared and they're shaking in their pants to exit stage left. Because if you are feeling that this is not something that you can handle, then maybe this is not something for you. And that's okay. But if you do stick around, you might find some interesting information about how you might be able to engage in this industry, even if you're not an accredited investor. So I hope you do stay tuned, but hopefully you're a big boy, big girl. You make your own decisions. Okay? Check it out. Default causes. Okay? Default causes. Again, default is the risk. The asset could default. And what I'm talking about are why things might default. Default's very simple. The asset's not producing. It's not performing. When we purchase a note, an asset, the finances, the legal rights to the finances on a property, the lender, the creditor rights of a mortgage process or mortgage itself, or a real estate asset, the asset could be performing or non-performing. And when it is non-performing, that means the people aren't paying for whatever the reason is. Now, what we need to understand with homes and real estate is that there are people behind them. They go through normal life changes, ups and downs, and swings, just like anybody else would. And so here are some of those causes I think that bring the humanity into the real estate industry and the note investment industry that we need to understand. Look, a death in the family. Deaths in the family bring on all types of complications. They bring on all types of emotions and turmoil within a family infrastructure or unit. And hey, after a 30-day period, one might forget to make their mortgage payment. It's pretty normal. Also, with the death in the family, you can be exchanging the estate, right? So you could be in a process where you're exchanging the estate. It might be going through a probationary period. There are lots of different things when deaths happen in a family. So the matriarch or patriarch could be the one that unfortunately passes on and moves on. And so the family unit really has to come to grips legally and financially with who's going to pay the mortgage on a property. Some people might even think that the mortgage is already paid. So those types of things really do happen within a death of a family. A divorce, very similarly, a traumatic experience for a family. They happen quite often now, over 50% in the US alone. So a divorce is something that can really bring some turmoil. Miss a payment here, miss a payment there. You could be really forgetting to pay, your mortgage. So loss of a job or income happens regularly, especially in a COVID era, which we have gone through. So loss of a job or income could really reduce the ability to pay those bills and cause a default. Not that you don't want to pay, but that you're probably unable to pay and maybe you're trying to figure it out. Sometimes it takes over 30 days to get a job. Student loans are legit. We're looking at $1.3 trillion in student loans. That is bananas, unheard of. So it's a lot of loan debt in that regard. And so maybe that particular interest level, 7% or higher, could be a higher interest point than your home, which could be at 4%. You got to do the math, right? So I'm going to pay down the student loans first, and then I'll get to the mortgage on the back end. Elderly people, they forget to pay the bills. Okay, they're elderly, so maybe they don't have the infrastructure in place to pay out the PNC bill on a regular basis, and so that could happen to a very large portion of our population. We've got a baby boomer population that is incredible, so that is probably a very likely scenario for why a home would default or an asset would default. File for bankruptcy, which again comes back to the job loss and other things. So these are humane reasons why a default could happen on an asset, but just because it's default doesn't mean that it cannot be cleaned. It doesn't mean that you cannot create a flexible situation for a person that might be favorable. For example, if they're paying a 16% interest rate or 12% or 10% interest rate, if you own the note and you know that it's going to generate quite a decent return for you, probably is not a big deal for you to say, all right, we don't need the 11%. Can we do 9? Can we do 8? Can we cut that down? How's that going to impact your month to month? And having that type of conversation could possibly change that default into a better situation. So let's look at the next one. We've got deferred maintenance. Deferred maintenance for pipes, basement, roofs, foundations, windows, and paneling. I mean, just generally, homes, they grow old just like we do, and so they need a little tender love and care, right? And so a 20-year neglect on a roof could lead to a poor roof. Some piping, some roots growing into some piping could lend to some problems that would be deferred, that a person may not know even exist. And so deferred maintenance are ways that we could lose quite a bit of money on a property if not assess property and you don't do your due diligence properly. Okay, here's a big one. This is the golden nugget that I love to give every single week. You will get one golden nugget out of the 5 slides that I'm going to share with you. This is the one. Okay, real estate protection pitfalls where people lose a ton of money. All right, look at. We got taxes and liens. So if a property has taxes on it, or they have liens on it, or something called encumbrances, which is, it could be taxes or liens, they could be taken away. You could lose it, especially if you're in a tax deed state. All right, you might have a real problem versus a tax lien state. Okay, county, city taxes, school taxes. What's called nuisance liens. There are all types of liens and types of encumbrances that can be placed on a home. If you don't take care of those up front, you could be in jeopardy of losing that property. Insurance is a big deal. What happens if you purchase the note and then it burns down? Listen, you got to get insurance on a thing. There's something called lender's insurance, and it's a property protection move. Very valuable, very important. I suggest you get it done. Servicing, very important. So my training that I've had, we talk about servicing, allowing someone else to collect the payments and keep you in compliance, especially when it comes to taxes, help you with your escrow. Those types of things are really important. And guess what? It's important to have someone to look out for those things on your best interest, especially if you're going to collect a lot of these notes. So servicing or having a servicing company kind of look out for you is a very good idea. So finance support, and they will worry about the distribution and compliance and making sure that the legal standings are in order. Let's get to the last one here. Now, this is the last one. Take my time a little bit with this one because there's not a whole lot of controversy, but this one could really take an entire episode to cover, and that's why I only have the acronyms on the left. I'll tell you which each of those are. In my first episode, I talked about the different types of notes, and is different types of paper. So you have your traditional notes, qualified mortgages. They're traditional. They're run-of-the-mill notes. You own it on a property. But then there are these, what's called weird paper, and they're called contract for deeds or land deeds. And there are another piece of paper called a LSO, which is a lease option, and they're a little odd as well. And depending on the type of paper you have, you would fall underneath a different organization of these acronyms here. The very first one and the second one are pretty standard. Those are the ones that you want to record at your local facility or government organization and or municipality. And the first one is the assignment of mortgage. The assignment of mortgage is the order in which your ownership lies. And so Jason sells it to Brenda, and then Brenda sells it to John. All right, and then now the dates need to align with Jason selling to Brenda and Brenda selling to John. Okay, so that's your assignment of mortgage. It's a list of the order of ownership as secured in a legal manner, right? Allonges is the signing over of the deed or the paper, okay, from one party to the next. And so very much like a check would work, right? You put your endorsement on the back of that thing, and it officially signifies the transfer of funds from one entity on the front end of the check to the other entity, right? And the person who signed it, they endorsed it. The assignment of lease, if you have a lease option, the assignment of lease or a contract for deed is another piece of paper or type of paper that you want to look out for. And a QCD is a quit claim deed, and those usually accompany a contract for deed. An assignment of lease, assignment of interest, and an ALO are other types of documents that need to be recorded depending on the type of paper that you have. Okay, so that is all that I have for the day. Those are the basic components of risk that exists within note investing. If you'd like to know more, please email me. We can have a conversation or join our Facebook page. In fact, I'm going to give you that. I've got a new slide for you guys today. Check that bad boy out right there. You've got the email at the top right. You've got the Facebook page second. You have my YouTube page there third, and then my LinkedIn if you want to get in contact with me. As usual, it's been fun. I hope that you really enjoy talking about accredited investors, about default, about deferred maintenance, real estate pitfalls, and recording. If you want to hang out more with me, please hit that like button, hit that notification bell, and subscribe to Engerman Estates. One family.